So got lots of interesting commentary coming from our three guests today, and hopefully kind of a forward look into 2025. Given where we are, I'd like to welcome Vibhuti Gurg, Director of South Asia for the IEEFA, Mike McGlone, Senior Macro Strategist at Bloomberg Intelligence, and Jamal Qureshi, MD, Analysis and Strategy at Petro Logistics. Thank you so much, gentlemen, for joining us, and Vibhuti as well. So thanks, guys. Good to have you. Let me start. Mike, perhaps I can go to you there, very late at night, early morning in the US. Thank you for staying with us. Um, you know, Direction for Q1. Let's talk a bit about that for oil prices in the context of what we're seeing. We've got an OPEC Plus meeting coming up where they may give clarity on what they're going to do with their volumes, at least, in the early part of next year. And also, please, in the context of the trade tariff rhetoric from Trump and what that's doing to the US dollar and what you think that'll impact in terms of, forward-looking inflation slash energy demand and oil price. Big question, but give us your take on the trend line that you see coming through in Q1 because of those factors.
Downward. It looks to me it's just a matter of time that WTI crude oil gets to $56 a barrel, or 57 was the average price in 2019. $56 is what Bloomberg Energy Finance estimates as the average cost of production. Every day that goes by that we're above this level, we have increasing supply, decreasing demand. So demand's declining from China. Supply, we notice from OPEC, is an overhang. U.S. supply is increasing. Exports in the U.S. liquid fuels and crude oil probably going to approach 3 million barrels a day next year, unless something shuts that down. And the key thing to remember about the rhetoric from Mr. Trump is he's going to do what he says he's going to do. And we're going to see tariffs across the board, tariffs on China. And this is something that some people in this country have been waiting for decades. So it's going to just, rip the Band-Aid off right away and then negotiate, let them negotiate later. So overall, crude oil is very much of a bear market, but it's not isolated. Looks like copper is just starting to break down. The grains have already broken down. Just excess of supply. Iron ore is going lower. The question is what stops it? And that is, we're still on the back end of this major pump in prices. We've seen the liquidity come on, the elasticity of prices, and everything moving downwards. Just a question of how much lower it goes. I don't know what stops, but in terms of the dollar, sure, it's stronger for the dollar, but we have administration officials want a weaker dollar. And the key thing I want to end with that's going to matter is people are worried about Trump and inflation in the same sentence, but we're seeing the deflation for commodities. So the thing in this country, the average cost of a gallon of gasoline is around $3 a barrel, $3 a gallon. I think it's going to $2. The average cost for diesel is around $3.50 a gallon. I think it's going to $2.50. And that's not profound. It's just what's happening. We have an excess of supply, declining demand. And if the stock market actually tilts a little bit lower, which it might be because of tariffs mean reduced profits. That means just we're seeing an ebbing tide at the moment. The key question is what stops this ebbing tide in terms of commodities. So overall, I'm still bearish crude oil, bearish most commodities, and generally bullish gold.
Okay, thanks, Mike. Well, bearish, and that just indicates bearish economy globally, let's say. And those signs are starting to come through perhaps more than they were early this year, whether it's for China settling into what we're seeing or indeed the US. Jamal, good morning again. Let's talk a bit about that bearish outlook and focus in on oil prices and OPEC plus and the decision it needs to make. Admittedly, it can adjust that month to month as it has been for 2 to 3 years. But we had a poll up there earlier today that we did this week, and one or two last week, which the majority of the market seems to be thinking that this decision to add volume back, as minimal as it might be, should be extended and pushed, at least 3 months out, if not through the next year. What situation does that put OPEC Plus in? Has it faced the fact that we have a glut of oil in the short term?
Right. I guess I would say the first challenge here is, in a potentially risky bearish situation. I mean, we keep bouncing, multiple times over several years now around that $70 support on Brent. Facing that situation, we are in a place where OPEC Plus is actually reining supply in fairly well. So in a bearish environment, we're already doing that. It's a huge risk to allow the cuts to go forward from a price perspective. So I mean, realistically, they are, as you say, taking it month by month. I would expect that to continue. You kind of have the plan to go up, but a market that says don't do that. So I would expect, given where they're at, given the fact that you've got places like Libya coming back on, you got the ever-present risk that KRG barrels might come back on the market out of Iraq. It's, I would say, for OPEC and OPEC Plus, it's simply too risky to be, running the cuts, but play it month by month.
And I mean, just on that point of KRG, and also, you've got the Libya factor that's been on and off. And of course, the whole non-OPEC equation. But I mean, on the quota side, on the compliance side, of course, this quota discussion maybe has gone out the window in terms of, the UAE pumping more and one or two others getting officially the go-ahead to do that. Admittedly, they're holding back to support the group. The compliance issue, is that still rearing its head? Is it something? I mean, obviously, if that came under control, we'd have a lot of support for prices, admittedly. Or is it all kind of in the one pot?
I mean, compliance with the official quotas is actually quite good. Compliance with the voluntary quotas, if we want to call them quotas, that's certainly something that has struggled more. In that sense, like you say, you have a couple countries, outliers, who are running things up, and that continues to run a risk. And yes, would that help? Yes, it would help. But we have offsetting risks as well. So the Iranians, big question, obviously, in this geopolitical environment, and the Trump administration coming in. But in general, they've continued to steadily increase. The latest, most recent numbers, there might be some coming off, but at the same time, too, that could just be natural fluctuation. So, you could have a few places like that could offset some of the higher production numbers. But these things go back and forth with the up risk and the down risk. So, I would say I wouldn't expect a huge change in the compliance overall. So that continues to run a risk, and when you can stay with the official, that may be about the best you can expect.
Okay, thanks, Jamal. Vibhuti, morning again. Let's talk a bit about India's demand for oil in the context of, where you would assess its economy is going next year. It's been one of the stronger supporters economically this year. It's not taking the place of China, but it's been a consistent oil, importer. Of course, some of that and a lot of that has been Russian oil at certain points in the year specifically. Give us your take on that going forward in terms of the discounted offer that gives to India, even Iranian oil is at a good discount as well. Oil demand going forward to 25, and what could be influencing that in India?
Yeah, hi. So I think we have heard from both Mike and Jamal in terms of how bearish this market is gonna likely be. And that means that there might be a bullish demand from India because we are very price sensitive consumers. When the prices are hovering, $90 per barrel, that's when we start cutting down on consumption of oil and gas product. I mean, oil specifically, it starts hurting the consumers. But as long as it's lower, we do see that, the demand keeps going up and up because the economy, we have witnessed it's grown to the extent of 8.2% this fiscal year. And for the next 2 fiscal years, it's projected that the economic growth will still be 6%, if not 8%. But based on the strong fundamentals that we have been observing, that the economy is likely to grow by 6%. And the demand for oil is specifically going to come from transportation fuels. We, as an economy, has been promoting large-scale, adoption of electric vehicles. So that is happening. But at the same time, we do have large fleet, which is still operating on petrol. While in India, the prices were market determined, but ever since, the prices went skyrocketing, the government has controlled the prices again, and we are not seeing petrol prices going up every 15 days, which used to be the norm. So given this kind of a situation, if oil prices go down further with cuts from, unless there are some knee-jerk reactions from OPEC when they start cutting down supplies to keep the prices high, we will see increasing use of more oil and gas in the Indian industry.
Okay, thanks, Vibhuti. Mike, back to the US and I mean, you mentioned inflation or deflationary impacts of the sort of Trump trade. I'd like to just focus in a bit on on the equity side, and that's the kind of thing you've always said it could be the trigger for so much more if it finally takes a turn. All we've seen is equities get a boost since Trump was voted in. Tax cuts obviously could be pushing that. But we've also got on the tariff side, threatening, probably proceeding with what he's saying he'll do with China, but that is going to come back and bite, things like US manufacturing, isn't it? It's going to be inflationary unless China just sits back and does nothing. And there's been lots of criticism within the United States for Trump to proceed with this because of that. After all this effort with the Fed trying to bring inflation down, that is a bit, would Trump be shooting himself in the foot in that sense? Is that a risk that he's willing to take?
No, I think the market is a bit misunderstanding. We all know tariffs are short-term, good for the dollar, inflationary. But in the U.S., the total trade is only 10% of the GDP at foreign trade, and total deficit, annual trade deficit is around, if you round up, around $1 trillion. The stock market's $63 trillion. It's nothing compared to, so the tariffs will be short term. But if we just have a little, and the stock market's so expensive, it's priced for perfection at these levels. When Mr. Trump was elected in 2016, maybe it was about 1.3 times GDP. Now it's 2.2 times GDP. So if we get a little 10% correction in equities, that's severe deflation on the back of what we've already mentioned. Jamal and Vibhuti already mentioned. We've seen global deflationary forces from commodities. I mean, crude oil going down, copper breaking down, grains going down, and gold going up, and we see it happening. So I'm not worried about it. And I think it's markets a bit misunderstanding the significance here. So also, it's a short-term thing. And to me, it's more important that if the stock market goes down, that's literally almost 10 times the effect of tariffs, at least in the short term. So that's one thing the Fed's fighting. The Fed's realizing it right now. They started to cut rates, made the stock market go up. It's up about a 1/3 basis on a 1 year, on an annual basis. That's so much animal spirits. There's so much wealth in the system because of that. You can't make inflation go down until the stock market stabilizes or goes lower. And I think that's what's happening. We're at that level where it's somewhat of an apex. So I'm not worried about it. And that's why I think one thing I've been pointing out for a while is that from the deflationary forces I see from commodities, I think one of the key things the markets really push back on is in the U.S. Treasury bond market. So you look at that 10-year note yield, it bumped up to 4.50. Right now it's around 4.28. In China, it's 2.06. The average of the rest of the world, including India, the top 5 countries, it's 100 basis points less than U.S. So U.S. Treasury bond yields are still very high. They're priced for the inflation. They're priced for deficit spending. So to me, the risk is we get a little tilt the other way. And a key trigger would be just a little backup in the equity market. Here's the way I think that's an issue, is now we're getting towards rebalancing time of year. Treasuries are very cheap. Bonds are stock market's very expensive. And I think what Mr. Trump's going to do is we have the midterms in 2 years. We have his legacy to think about in 4 years. I think he's going to do everything, his Trump administration can do everything they want to do as soon as possible to make the effects show up within 2 years. That means a little bit of short-term pain.
Okay, thanks, Mike. Jamal, back to you. Let's talk a bit about shipping and freight, which is one area that your company follows and tracks, and what that's telling us about the health of the sort of oil demand market, if you like, in terms of whether it's for products or for crude. It seems to have been the freight rates are sort of rage bound, not being swung too much by even geopolitics. And those sort of new flows that we've seen settle in over the last year or two. Outlook for the freight market going forward in Q1.
I mean, you're not going to have any particular demand side pressures likely. I mean, there is certainly some seasonality at this point. Russian FSU exports are at a seasonal low, so that will certainly take things up. But on a sort of quota bound perspective, and as well the marginal increase you might get from non-OPEC countries, I don't think you're going to see a lot of demand side pressure there. In terms of sort of the larger fleet, I mean, utilization should get a little bit of a boost, but I wouldn't necessarily see major changes going forward into Q1. Obviously, as we get into a larger picture perspective later in 2025, the possibility for some ramp up there is still there.
Okay, and I mean, in terms of the geopolitical risk premium that we've seen, very mildly come in and out of the oil price and even shipping rates, etc. Is that, do you think, still playing on people's minds? We have a ceasefire in the region that may be signed between at least Lebanon or Hezbollah and Israel, possibly today, tomorrow. There seems to be some gossip around that, wishful thinking. Is the market factoring in those types of risk factors, or has it settled completely into a new normal?
I think, I mean, the geopolitical risk at this point is certainly to the downside. And to go back to the freight rates, obviously, if anything settles down in Yemen, although I will say I would not expect that, but if it did, that's obviously bearish as utilization will go down, being able to go through Suez more than the Cape than they currently are. But I do think the geopolitical risk premium is likely to continue to ease off. I mean, once you have Hezbollah out of sort of the fighting picture, for whatever reason, at that point, the ability to expand the conflict has taken a significant downward hit, especially since the Israeli sort of, not that the fighting spirit is gone, but they will take it all out in Gaza at that point. The military certainly for the Israelis has faced societal attrition. And in that case, the incentives aren't quite there. And obviously with the incoming Trump administration, I believe they're going to focus more on sort of the sanction side with Iran and not sort of the military side at this point. That's Trump. When we talk about Trump wanting to do what he says, and I think especially in the second administration more than the first administration, people talked a lot about how there's going to be relatively less chaos. I would definitely use that term relatively. At that point, the whole notion of I am the anti-war candidate, however, whatever you believe about that, I do think we've seen enough feelers out there, both in contact with Netanyahu and unofficially with the Iranians, that at this point there's going to be a desire to tamp things down.
Yeah, well, hopefully he'll come up with some magic formula and come up with something that's going to be a good legacy for him, Trump. Thanks for that, Jamal. I mean, you mentioned sanctions, and I'd like to perhaps go back to Mike on that from the US perspective. But Vibhuti, to you next. But let's quick look at the survey question there about the geopolitical risk premium. Is it, if whatever it is at the moment and whatever people believe it is in the oil price, is that going to be removed? And what is it if we see, the steps towards some ceasefires in the region here in the Middle East? Is it going to be a 5+ removal, 1 to 2, or none? What's in there at the moment in terms of geopolitical risk in the oil price? It's been on the low side, all things considered. Vibhuti, I'd like to go to you to give us your perspective on the COP29 meeting, because we just had that concluding over the weekend, quite contentiously, in that sense that, you had the developing countries walking out of certain talks because of the whole financing, the commitment from the developed world not meeting expectations at this stage. India took a big stand there as well. Give us your take on that and whether you think the meeting was a success or a failure, and why, and what would be the next steps?
I think it was a mix of both. So there was few things to rejoice about as far as carbon markets is concerned, but as far as, while the summit was being dubbed as the finance COP, so there was huge expectation, especially from the emerging and the developing countries, about the commitment from the global north and kind of increase this $100 billion commitment, which was agreed way back in 2009. And it's been 15 years since that commitment. The trajectories or the commitment in terms of, limiting the global temperatures to 1.5 degrees, the amount of investments that are required are huge. And from the perspective of especially why some of the developing countries walked out of that agreement, and especially India raising a big objection, was on the adoption of common but differentiated responsibility. Because historically, the developing countries have not been responsible or contributor to the kind of climate crisis we are witnessing now with increased incidences of floods, heat waves. They have been much more vulnerable. They have been impacted the most, but they have not been responsible for that. So I think, yes, there was huge ask in terms of the new collective quantified goal, which is the NCQG, to be to the order of 1.3 trillion US dollars. I knew from the very beginning that's a tall ask. I wasn't expecting that there'll be an agreement for 1.3 trillion.
No, but they didn't even get through to the 500, did they?
Yeah, so that is what is very more disappointing. While 1.3 trillion would have been difficult, and that ask was from 2030, but now the agreement is just for 300 billion US dollars, and that too from 2035. While there is a mention of 1.3 trillion US dollars that different actors will try and mobilize this, but it's not obligatory. And even this 100 billion US dollars, I think 70% of the funds was in the form of loans. And the developing countries, which are already in the debt trap, you are just spiraling that debt situation for them. I think that is not what was desired. So there's more ask in the form of grants, or concessionality was something, again, which was a big ask, which is still missing. So yeah, I'll see it's a bit depressing to see on the quantum, as well as more importantly, the quality of funds is still, you really have to pen down to how this flow of funds would be, in what form and shape.
Okay, thanks for that, Vibhuti. Mike, on that front of emissions and, 1.5 degrees centigrade, I've read at least 3 articles in the last week on the revival of offshore drilling. That it's all the rage again, whether it's this brand new spanking platform that Shell is operating, I think not in the Gulf of Mexico, somewhere, and BP now again back in the Gulf of Mexico, bravely, after the disaster that we saw 10 plus years ago. Is that just, again, energy transition taking a back seat, particularly in the Americas, and drill, baby, drill? Why am I reading so many articles about offshore drilling?
I think you're pointing out facts. So we've tilted back towards a drill, baby, drill administration, and it's going to accelerate an underlying trend, and that is the excess of supply versus demand in the U.S., Canada, adding some Brazil, adding some Guyana and Mexico. You see a pretty substantial surplus of supply continuing to increase and accelerating. We're going to delay an inevitable shift to renewables. I drive an electric car, and the fact is my electric car is 10 years old. Is just a matter of time that's going to take over. But we all see what's happening. It's what's happening globally, most notably in China. The massive deflationary forces in renewables, EVs, solar panels, batteries, everything out of China is substantial. And that to me is where everything's going. That's why I think we're in the middle of this paradigm shift that's just bad for prices. But as far as emissions, sure, it's a short-term blip. It's from a US standpoint, most of the emissions in the world come from China. And that's shifting rapidly. So to me, it's just the lesson from the book, The Price of Tomorrow by Jeff Booth. Technology is happening so fast, and it's much cheaper in renewables. It's just a question of time. So that's why I point out, yeah, at some point, that's all good for copper, but not with the global economy tilting and China completely dependent on deficit spending. So for me, emissions are less significant in terms of price. But for now, we're going to have a bit of from the US, a pushback. But overall, the technology is overwhelming. That means reduced emissions.
Okay, thanks, Mike. Jamal, you mentioned sanctions in your last comment. I just wanted to ask you again, and we talked about freight earlier, but the dark fleet sort of freight, if you like, on the water, Russian, Iranian, Venezuelan, etc., still freely making its way to the destinations that'll take it. do you see any change to that dynamic as we go into next year?
Well, I think one of the heaviest questions there, obviously, is what happens in Ukraine if you get a potential settlement there of some sort. I've historically always said once sanctions go on anywhere in the world, getting them off is almost impossible. It becomes a very, very long-term issue requiring large changes. But Russia has a lot more leverage in these discussions as opposed to a much smaller country dealing with sanctions. So I would expect you're going to see the Dark Fleet light up a little bit. When the settlements finally comes of some sort, I think we're going to see a significant amount of that coming into visibility again, but also a lot more crude and products staying in the Atlantic.
Right.
Products in the Atlantic are going to be pressured, though. I mean, we're already starting to see this as a result of Nigeria. I mean, obviously product traders have, but I think maybe it hasn't filtered through to a lot beyond the product markets. What a gigantic sea change the Dangote refinery is, being able to meet a lot of West African demand. They're having their hiccups getting up financially and logistically, but that's already made some significant headway. That's going to continue. So as a result of that, I think you're going to have I don't want to go so far as to say a glut of tanker availability in the Atlantic. But the picture's going to change so significantly, if that happens.
Thanks, Jamal. Vibhuti, I mean, how much, we had a period in the second quarter of this year where India was taking a lot more Russian oil. Price-wise, maybe that was the incentive. But again, going forward, what do you think is in India's planning? It's still going just for the lowest price out there, or does it have other considerations, given its neutrality posture, with between the West and East, etc., its relationship with China, and Russia. So, what has been the trend the last couple of months, and what do you see going forward?
I think price is a big driver in terms of deciding where India is sourcing its supplies from. So definitely when there was a huge discounts offered from the Russia when the war started. So at that point of time, there was large kind of supplies coming from Russia. But then soon thereafter, when the premiums were reduced, I think we were again back to importing more from US or the Middle East. So I think India is no longer receiving those kind of premiums from Russia anymore. So it's like they are diversifying their sources because the dependency is huge. And given all the geopolitical risks, so price being one, but I think now the geopolitical risk is also driving which countries India should be importing from. And as I said, it's not like restricting its import to one or two countries when as a country you are importing more than 85% of your oil needs from different countries. So it's very risky to place your bets on one country. So I think that's how India is kind of strategizing its imports from different countries, and price will be one of the big driver for sure, but the geopolitical risk in the current scenario will be another important driver.
Well, there's certainly plenty of sources out there at the moment. I don't think there's a panic on that, and the price, as you said, is reasonable. Mike, let's get to you just for a final comment. I know you're not a China expert, but in the context of the US-China trade thing, the yuan taking a bit of a hit with the rhetoric in the last few days, but more just to give your perspective, if you have one, on what you think China is indicating it'll do from a stimulus point of view to revamp its economy. That's going to impact its exports, of course, of a lot of finished goods to the US, the appetite for that coming from where you are. What would be your gut feeling on how the Chinese economy is going to go in for the first half of next year?
So as a commodity strategist, we've all had to become experts in China and just read and study everything we can. I've been saying for a number of years, to me, China is very akin to Japan about 30 years ago. Their GDP, about $4.2 trillion, is the same as it was 30 trillion years ago. I'm sorry, about 30 years ago. We're seeing the same thing in China right now. China is completely dependent on fiscal and monetary stimulus for stability. By being a decisive enabler, as NATO put it, of the war in Ukraine, it's completely shut off the rest of the world. It's created a bit of this axis of antagonists. And its major export demand markets, the U.S. and Europe, are shutting down. I mean, it's just it's inevitable. It's a macro situation. That's a massive paradigm shift. So I think China is going to hit a normal long-term decline, and it is already fading there now, unless they open up their export markets, U.S. and Europe, and they've already shut them down. And you can see that, and just look at crude oil imports. Imports around 11 million barrels a day. That's stagnant for almost 4 years now. That's stopped. It's starting to head lower. So I look at, here's one way to end this. I think the key thing to watch is Chinese government bond yields. 2.06% is the 10-year note yield in China. In the US, it's 4.28%. So they are approaching Japan. It's the Japanification of China. To me, that's where the trend is. What stops it? Unfortunately, the current trajectory is it's probably going to get worse.
Okay, thanks so much, Mike, for wrapping up for us there, and to Vibhuti and Jamal. There's our response today in the survey. Majority, $1 to $2, which is kind of the geopolitical risk premium, that to zero, which what the sense that we've been getting in the last few weeks, regardless of the events that we're seeing unfold. So there you go. So not a huge impact either way in terms of what might happen next on the geopolitical front, particularly in the Middle East. But thank you so much, everyone, for joining us today, and have a great week ahead.
Thank you very much.
Thank you.